Have you ever checked your bank account and thought, I have money, but it doesn't feel like enough anymore? Same paycheck, same hours, but life feels heavier. That's not your fault. Money quietly lost value. Imagine two families in 1970. Both saved $10,000. One kept cash, the other bought gold. Today, the cash family has lost 70% of their purchasing power. The gold family? Their investment is worth over $300,000. Today, I'll show you real moments when gold protected people and money didn't. This isn't about getting rich. It's about not getting poor. October 1929, the stock market crashed. Within 4 years, over 9,000 banks failed in America. Your savings? Gone. Banks locked their doors. But families who owned physical gold survived. Gold could be traded for food, land, and safety. In 1933, the government ordered citizens to turn in their gold. Why? Because gold held real value when the dollar was collapsing. During the Depression, unemployment hit 25%, but gold remained gold. An ounce in 1929 bought a quality suit. An ounce in 1939 still bought a quality suit. The purchasing power stayed stable. August 15, 1971. President Nixon made an announcement that changed money forever. The gold standard was dead. Before that, every dollar was backed by gold. After, pure paper, fiat currency. In 1971, gold was $35 per ounce. Today, over $2,000. Did gold get expensive? No. The dollar got weaker. Real example. In 1971, the median home cost $28,000, about 800 ounces of gold. Today, the median home costs $420,000. In gold, 210 ounces. In gold terms, houses got cheaper. Same with gas. In 1971, 1 ounce bought 97 gallons. Today, 1 ounce buys 570 gallons. The pattern is clear. Dollars got weaker. Gold maintained purchasing power. Two factory workers, 1975. Both saved $20,000. Robert kept cash in a savings account. James bought gold at $160 per ounce, about 125 ounces. Fast forward to 2015. Both are 90 years old. Robert's savings grew to $50,000. Sounds good? That $50,000 has the purchasing power of $6,1975. He lost 70% of his purchasing power. James's gold, worth over $150,000. He didn't get rich. He got protected. Same work. Same start. The difference? Asset choice. September 2008. Lehman Brothers collapsed. Stock markets crashed 50%. The S&P 500 went from 1,500 to below 700. Retirement accounts were cut in half. Housing prices fell 40%. But gold started 2008 at $850. By 2011, it hit $1,900, a 124% gain, while everything collapsed. Why? Because when fear grips markets, when banks fail, when governments print trillions, people flee to safety. And safety means gold. Real story. A woman ready to retire in 2008 had 80% stocks. She lost 45% of her savings. Had to work 6 more years. Another investor had 15% in gold. His stocks fell, but gold cushioned the blow. He retired on schedule. This wasn't luck. This was diversification. March 2020. COVID shut down the world. Governments printed more money than ever before. Result? By 2022, inflation hit 9%. Highest in 40 years. Grocery bills doubled. Gas surged. Rent skyrocketed. $10,000 in savings in 2020 could only buy what $8,000 bought by 2023. You lost $2,000 in purchasing power without spending it. Gold. March 2020, it was $1,500. By August, over $2,000. A 33% gain in 5 months. Real example? A couple saved $50,000 for a house down payment in 2019. By 2023, homes went from $250,000 to $400,000. Their down payment wasn't enough anymore. Had they put half in gold at $1,400 per ounce, 18 ounces, those 18 ounces would be worth $36,000 today. Combined with cash, they'd be much closer to their goal. This is your economy right now. Now, the honest truth, gold is not perfect. From 1980 to 2000, during the greatest stock bull market, gold went nowhere. It fell from $850 to $270. Meanwhile, the S&P went from 100 to 1,400 points. If you held only gold, you missed massive gains. Gold doesn't pay dividends, no cash flow. You can't swipe it at Starbucks. Storage costs money. So why own it? Because gold is insurance. You don't hope your house burns down, but you buy fire insurance anyway. Most advisors recommend 5 to 15% of your portfolio in gold. Not 50, not 100. A measured allocation. Think layers. Emergency cash for immediate needs. Growth investments for building wealth. Gold for protecting wealth. Gold is layer 3. Critical, but not everything. Gold's power is psychological. For 5,000 years, every civilization treasured gold. Egyptians, Romans, Chinese, everyone. Why? Gold is rare, beautiful, eternal, and universally recognized. It doesn't depend on anyone's promise. When you hold gold, you own it. A stock depends on a company. A bond depends on repayment. Currency depends on government. Gold depends on nothing. That's why central banks hold over 35,000 tons. The US holds 8,000 tons. Germany, 3,300. China's buying heavily. If gold was worthless, why would the smartest institutions on Earth hoard it? 4 ways to own gold. Physical gold, coins and bars, complete control. But storage costs and security concerns. Gold ETFs like GLD or IAU. Easy to buy and sell like stocks. No storage needed. But you don't own physical gold. Mining stocks? Companies that mine gold. Higher potential returns but company-specific risks. Digital gold apps. Buy fractional amounts stored in vaults. Low minimums, but platform risk. My recommendation, start with a gold ETF for simplicity. Gradually add physical gold for crisis protection. Only invest money you won't need for 5 to 10 years. Gold is preservation, not trading. Every paper currency in history has eventually failed. The British pound lost 99% of its value. The dollar lost 97% since 1913. But gold, never gone to zero. Not once in 5,000 years. The families who survived crises didn't work harder. They respected history. They understood that wealth isn't just about making money, it's about keeping it. They knew that in a world of uncertainty, you need anchors. And gold has been humanity's anchor for 50 centuries. Gold doesn't ask you to believe, it asks you to remember. Remember the Depression, 1971, 2008, COVID inflation. Remember every time paper failed and gold endured. You don't need to predict collapse. Just acknowledge uncertainty exists. Economic cycles will continue. Crises will come and go. But one thing remains constant. Having 5 to 15% in gold is simply prudent. Not to get rich, to not get poor. Not to beat the market, to survive it. Not to time the perfect moment, to be prepared for any moment. Your grandparents understood this. Now it's your turn. Money asks you to believe. Gold asks you to remember